As you say, the ECB does have some room to cut rates, maybe compared to the Fed that seems to be closer to the neutral rate and have perhaps less room. Why there is that interest rate difference developing, why the euro is weaker. And I think based on the statement, though, is that it's interesting they acknowledge that the disinflation is on track, but they still see a lot of tightening in the system. So they still have restrictive policy. So I think that's their room, right? If disinflation stays on track, and yet they have restrictive policy, they could cut more. I think this is why the market is pricing in a path for the ECB with more cuts, about 95 base points roughly for this year remaining, compared to the Fed about 50. So I think that's right. I think you could see the sequential sort of cuts every quarter, really driven by their forecast on data. I think that they're going to tie more into that to keep themselves data dependent by giving them time to assess the data. I think this is then becoming very predictable, like we've had in the past. So these yields decline we're seeing in Europe today is not so aggressive for that reason. I think you're going to see some ranging in yields from here.
So explain to us the range here and what are you expecting from a bond market perspective? Because obviously, as we are watching now the ECB announcing another rate cut, the Fed pressed pause yesterday. So what does that mean for the bond market? Also at a time when we started this year seeing a lot of volatility in that part of the market.
Yeah, I think we can expect that the 10-year bond yield, let's take that as the benchmark, probably ranges anywhere between 2% and 2.3, roughly where we are now today. Whereas the Fed, the 10-year, will probably be more like 4.5-ish or about where we're now to 5%, because there was a reaction yesterday to the FOMC meeting, right, from the president. And it was, to me, really much about an economic calendar of like, I'm going to drive growth, bring energy prices down. It's all lifting growth. So it actually gives you an upward bias to rates in that sense and yields. Whereas in the Eurozone, we're dealing with weakness. We're dealing with disinflation that stays on track because of the weakness. So the range is not only lower, but it's also lower rates. So I think the interest rate differential between bonds and treasuries may actually widen as a result. You know, if we're going to go to the lower end of the range of 2% on bonds and the upper end of treasuries, then we're going to get 300 basis points of interest rate differential. That may be in the cards in the future.